Since many of you are interested in what's happening in the real estate market, I thought I'd update you on the current state of things, at least how I see it from Brooklyn. Inflation, recession, market volatility, geopolitics, rates, etc. The big picture is pretty murky, leaving most wondering what it all means. In my world, that typically means how does it impact real estate and what should buyers and sellers do? Inflation spiked to its highest level since the 1980s. In order to rein it in, the Fed raised rates sharply and mortgage rates hit their highest level since the early 2000s. As a result, housing starts declined, as did mortgage applications. There's talk that Fed policy might push the economy into recession. While that may happen, it's expected to be different and hopefully much less severe than the last one in 2008. With respect to housing, one key difference is that low-rate refinancings have reduced the debt burden that many homeowners face. As a result, delinquencies are much lower than in 2008, and homeowners are under less selling pressure. Additionally, unemployment has been low relative to 2008. While it spiked during the pandemic, it came down pretty quickly. It's possible that it increases again, but it's not expected to be as severe as during the global financial crisis in 2008. One of the bigger impacts to housing in all of this is that the sharp increase in rates decreased purchasing power for many buyers, particularly younger buyers and those on the financial margins. As a result, some buyers were forced out of the market and into the rental market, and overall purchase demand for properties decreased during the second half of last year. While overall demand typically drops at year-end due to seasonal factors, this past year dropped even further. While demand dropped, we still haven't seen a significant decrease in prices. Part of that is due to the fact that prices lag the market. Since it takes several months for a closed transaction price to become public, real estate prices are typically a lagging indicator of actual prices and tone in the market. One of the reasons that prices haven't dropped is that supply has also declined. Why is it so low? A number of reasons, but some of the more likely would be less financial stress on sellers to sell, the inclination of more homeowners to age in place, the cost of moving to and difficulty in finding a replacement property, developers pulling back on projects because of their economic outlook, and the general constraints on building affordable housing in New York City. So despite lower demand, because of lower supply, prices have been relatively stable. This chart combines the effects of supply and demand to give a general pulse on the market and whether we're in a seller's or a buyer's market. In Brooklyn, for much of the past 2 years, we've been in a strong seller's market. Towards the end of last year, that shifted into more of a neutral market, and in certain neighborhoods, a buyer's market. I expect that as we enter the spring, barring any major economic or political disruptions, we'll likely shift back towards a seller's market. One of the reasons we have underlying demand strength is demographic. Millennials are now the biggest sector of the population, and they are at peak home buying age. Many have been in the rental market and are looking to own their first home. Given that, I expect to see housing demand strength for many years to come from that sector. While all of this is a useful backdrop, and it's important not to generalize for a specific situation, supply-demand dynamics can vary dramatically across neighborhoods, with significant differences across price per square foot, days on market, and premium or discount to asking price, among other things. Eventually, everything boils down to a particular property in a particular situation. So, in summary, I would say my general outlook is the following. Moderating views on inflation, recession, and rates have created some room for optimism. Supply will likely remain tight, given less selling pressure and less new development, particularly for first-time home buyers. Demand is likely to increase as we enter the spring, given expectations of rate stability. Strong buyer interest likely continues with first-time home buyers and millennials. Recession may result in unemployment increasing, but it's likely to be shorter-lived and less impactful than 2008. Prime properties will continue to attract more relative demand and multiple offers. Negotiating leverage shifts back to sellers with excess demand, but case-specific depending on neighborhood, property, and situation. Many sellers will likely pull their property from the market before accepting a below-market price. Lower supply is likely to create price support, despite lower demand, diminishing the prospect of steep discounts. So that's all for now. Those are my thoughts. If you have any questions or you would like to discuss it further, please feel free to reach out.